What I think we'll probably do is create boom bust cycles. Again, you can't have the bust cycle going below the level of central bank liquidity because optically they make it rise. This is what people don't yet understand. But of course, the stock market should go down 90%. Can't happen. Literally can't happen because of the debasement. It's a money illusion. But what I think we'll do is see, hey, off we go to the races. That's what happened in 2018. 19, early 20, we actually diverged from the central bank balance sheet massively because people starting to figure out this game, which is the moment the Fed stop tightening cycle, markets take off because they know that the probability of more cowbell, more central bank printing of money, more interest rate cuts is coming. And so therefore we get boom bust cycles. So the boom times are too big and then you get a bust. And people know that from crypto as well.
Over the past few decades, there has been a sharp increase in global debt, which has left people's financial situations unstable and having an impact on both economies and individuals. In an insightful discussion with Tom Bilyeu, Raoul delves deeply into the intricate connection between rising debt, inflation, and the widening wealth gap. He describes how government actions and the practices of central banks have simply covered up underlying systemic issues since the 2008 financial crisis. According to Raoul, these actions have made wealth inequality worse, which has caused social unrest and economic uncertainty. In this interview, Raoul highlights the significance of comprehending the cyclical nature of inflation and debt and issues a warning that another global catastrophe may arise unless there is a substantial change in mindset and policy. He emphasizes that if we are to find a sustainable road forward, we must address the core issues, which include unregulated monetary policy and stagnant wages. Come along as we examine Raoul's ideas about the future of the global economy and go further into his conclusions. Remember to hit the notification bell, like this video, and subscribe to the channel for more insightful videos.
What we are doing since 2008 is mutualizing the bankruptcy of the system via the debasement of currency, which is the...
When you say mutualizing, you mean making it everybody's problem?
Yes. You can either raise taxes, which they're trying to do too, but they're also printing currency via the mechanism called quantitative easing, which is actually debasing the currency, which means that every time they do it, asset prices optically rise. They don't actually rise, because if you look at the central bank balance sheet and divide all assets by it, so you're changing the denominator, it's normally US dollars, but when you use the balance sheet, you say, okay, this is the purchasing power of dollars. Now, how many dollars are in the economy or excess printed? And what you find is something like the S&P 500 has gone nowhere. Real estate, gold, gone nowhere. And there's only two assets that have actually outperformed, which were crypto and technology. After the Fed started monetizing or lowering the value of the denominator, the economy grows at 2%. The government needs that to pay its interest because it's 2%.
How does it use that to pay its interest?
Well, basically it comes...
Because they're just taking more in taxes?
Exactly, right? There's a level of economic growth that needs to service the interest payments. But if everybody's interest payments are too high, the answer is firstly to have the interest rate as low as possible. Mm-hmm. Which is why the Japanese have a much lower natural rate of interest than everybody else, because they're 260% of GDP in debt. But their companies are less in debt.
So they've trapped themselves. They have so much debt they can't let the interest rate rise.
Nobody can. This is why we're going to have a recession and we're going to cut rates back down to zero. It's impossible to work. So this is the thing, is once all of these governments hit 100%, then you either blow up the private sector, the banking sector, corporates, or the government sector. You choose.
How?
Because there's not enough income to service that level of debt, because GDP growth keeps declining. So economic activity is what pays the interest. If you don't have a job, you can't service your mortgage or your credit card, right? Fact. And if your debt growth keeps going up, you need to keep your wages going up to pay your debts. That's the GDP side of the equation. But what we're finding is that all debt that is in excess of GDP at government level is ending up on the balance sheet 3.5 years later. And I did the maths on this, and I think I was the first person to really I don't think anybody's really figured this out yet. I went and looked at this, and I realized that what they were monetizing was the interest payments on the debt 3.5 years later. Okay, why 3.5 years? In 2008, all interest rates went to zero. Every government refinanced itself at zero. And most of the debt for all governments is in the 3 to 5 year sector. So somewhere between 3 to 5 years, 3.5, 4 years. And what happens is every time you service the debt, you need to get the interest rates back down again. You end up having a recession. You get this very cyclical phenomena.
Because they are they deferring the need to pay for 3 to 5 years?
Nobody pays back debt. No, nobody is paying back any debt anywhere. So what they're doing is every time it comes to pay to service the next amount of debt, it ends up on the Fed balance sheet. Now, it actually happens because there's an economic slowdown driven by the debt. But that's what happens. There is a marginal difference in the size. This is true of the US, the UK, the EU, Japan. They're all the same. And the difference of the balance sheets is slightly bigger. And the difference is every time there's a direct financial crisis, they have to put direct money in. So we've already just seen a little bit of that in the US.
According to Raoul, since the global financial crisis of 2008, the system has been mutualizing bankruptcy, or spreading financial responsibilities amongst itself. In order to handle insolvency, debasing currencies is required. Governments mainly use two tactics: raising taxes and printing more money through quantitative easing. Although this gives the impression that assets like stocks and real estate are becoming more valuable, their true value hasn't improved when inflation is taken into account. This situation has been especially tough on younger generations. Millennials, for example, started their careers just as the Federal Reserve began these practices, making it harder for them to afford assets like housing and widening the wealth gap between those who own assets and those who don't. Raoul goes on to say that governments need economic growth in order to pay the interest on their debt. Ideally, the economy should grow by about 2% annually in order to generate enough revenue from taxes to meet these expenses. Nonetheless, maintaining low interest rates becomes crucial when debt levels and interest payments rise. Governments are faced with difficult decisions if debt surpasses 100% of GDP. As development slows and debt increases, they run the risk of harming the banking industry, the private sector, or their entire economies. For this reason, a lot of analysts predict that there will be more economic difficulties in the future. Let's go back to the interview to gain additional understanding on this subject.
Thing that's actually driving the S&P 500 is the Fed balance sheet. It's an optical illusion. It's a money illusion.
So the price simply rises to meet the level of inflation caused by printing money.
Correct. You're readjusting the price. So that is what's going on. And so then when you understand that, and it's 97%, you understand that nothing matters apart from this liquidity, which is what I've been trying to tell people. Is sorry, all your economic models are wrong. Yes, you need to forecast the business cycle to know where you are in the probability of printing money cycle, but that's all that matters, and it drives assets. And that's why people right now are getting very angry because the stock market's going up, and they're like, yeah, but don't you know there's a recession? Yeah, I know that the answer to a recession is more cowbell, printing of more money. I know what drives liquidity. It's driven by the business cycle, and there are certain cycles that are forward-looking. The Chinese credit cycle happens to lead by about 18 months or 2 years. The business cycle is the ebb and flow in economic activity that occurs, and that's a boom and bust, a recession, expansion. And one of the things we do is when the business cycle is too hot and inflation starts rising, central banks tend to raise interest rates. That tends to bring down economic activity. I think even without a central bank, interest rates would rise naturally, because I think the free market can set interest rates without a central bank. And then the economy slows down again, and we see this endless cycle. So we're looking at more than a doubling of the NASDAQ from here. We're looking at another gigantic crypto run. That's into 2025. So we're seeing huge moves that just come from the debasement. And I've gone through in the Everything Code article that I wrote for Global Macro Investor, which is my kind of premium research service. In that, I've gone through various ways of proving this all out. So that's what I think I can do. But your observation, I think, is really important. Okay, when people, I mean, I've sent this to quite a few people, and obviously the subscribers of Global Macro Investor are kind of the world's most famous hedge fund managers, asset managers, and I think it really shocked people and resonated with people. They're like, oh my God, everything makes sense now. And so once you see it, it all makes sense. Now, as it becomes more public as a thesis, and Mike Howell at Cross Border Capital has been talking some elements of this, liquidity, you can see liquidity becoming part of the conversation on financial Twitter and stuff now. What I think we'll probably do is create boom-bust cycles. Again, you can't have the bust cycle going below the level of central bank liquidity because optically they make it rise. This is what people don't yet understand. But of course, the stock market should go down 90%. Can't happen. Literally can't happen because of the debasement. It's a money illusion. But what I think we'll do is see, hey, off we go to the races. That's what happened in 2018. 19, early 20, we actually diverged from the central bank balance sheet massively because people starting to figure out this game, which is the moment the Fed stop the tightening cycle, markets take off because they know that the probability of more cowbell, more central bank printing of money, more interest rate cuts is coming. And so therefore we get boom bust cycles. So the boom times are too big and then you get a bust. And people know that from crypto as well. The long-term trend remains intact, but we keep getting these huge booms, collapse, boom, collapse, but the trend is still up. I think that's what we'll see. We'll be more like the crypto cycle, which is pretty much what we've just seen as well. We had a big collapse last year and now we're straight back into the boom as we're starting to forecast this.
According to Raoul, the balance sheet of the Federal Reserve has a significant impact on the performance of the S&P 500. He refers to this as an optical illusion in which actual economic development is not the cause of the increase in asset prices, but rather currency depreciation. In essence, the Fed creates the illusion of rising values by inflating asset prices to keep up with inflation as it produces more money. Raoul highlights how important it is to comprehend this liquidity-driven dynamic and speculates that conventional economic models might be overlooking it. He contends that despite worries about a recession, increasing monetary stimulus, or, as he put it, more cowbell of money printing, is frequently the answer. He adds that some economic cycles, such as the Chinese credit cycle, can be forecast, with evidence pointing to the future dictating how the markets will move. Looking ahead, Raoul believes that further depreciation and liquidity dynamics will fuel substantial growth for the Nasdaq and cryptocurrencies through 2025. Although this insight may come as a shock to some and strike an emotional chord with others, he admits that it's becoming more and more common in financial conversations, particularly on sites like financial Twitter. For more detailed analysis, check out Raoul's full discussion and insights in the description. Don't forget to like this video, subscribe to the channel, and turn on notifications for more content